Welcome to second module of financial derivatives. I am Professor Ashok Patil. We saw in the previous class that the derivatives are the instruments which are legally enforceable and executed in the future. The value of the derivatives depends upon the underlying assets. For example, if we are having a share as an underlying, as the share price fluctuates, the difference between the share price is captured in the derivative instrument. We also saw the second point, the fluctuation which is seen in the stock prices is reflected in derivative instruments disproportionately. What does that mean is that if there is a 2% variation here, you might see that here could be 10% variation. Just to remind you that we are having the derivative instruments of two broad classes is forwards slash futures, and then we are having options. We also saw that you can actually take two kinds of position here, long and short. And here we are having calls and put as two products, and in each one we can take long position and short position. Similarly, in put also you can take long position and short position. Today we are going to look at mechanism how the forwards work. And we also saw that the only difference between forwards and futures is that the forwards is the OTC agreement over the counter between two parties, and future is based on the exchange. So the products are standardized, delivery times are set, whereas in the case of forwards, it depends upon the parties involved in this contract. Now, we also saw that last class the long forwards or future is the position taken, and what do we mean by position taken is the contract is signed by the party who believes that the price of the underlying is going to go up in future. The short position is taken in the derivatives instrument if the party believes the price of the underlying is going to go down. Now, these are the basic things which we saw, and the other side we saw that options, as the name says, has an option or the choice to execute or not execute the contract in future, depend upon whether you are profitable or at loss. If you are profitable, you would like to execute. If you are fearing that there is going to be loss, you will not execute. Now, we have seen that calls and puts are two options, and each one you can have long and short. The same philosophy also goes here. You will take a position of long in call option if you believe the price of the underlying is going to go up in future. Short is the opposite of long, and as you can very well guess, short position is taken by the party in call if you believe that the price of the underlying is going to go down in future. All right, so coming back, we can look at the mechanism of futures market. And as we have seen last class, so it's a contract between the two parties. Forward basically is OTC instrument, over the counter instrument. So it is between two parties involved, and they know each other, and they decide the specifications and contract details between two parties. Whereas in the futures, it's an exchange traded instrument, and therefore the terms of the contract are standardized. And you can see that both the buyer and seller decide this contract, and the delivery of an asset at a future point in time with price agreed upon today. So we can see that in terms of the timeline. So let's say this is Jan and this is March, and we talk about two markets, spot market and forward market. Now, when we are looking at the spot market in January, there is going to be a price of the underlying, and this is the forward market, the price of the contract. So we can see that if the spot price of the product is 50, the forward price of the contract today in month of Jan is going to be what the traders believe that this underlying price is going to be here. So if traders in general believe that the price of this is going to be around 60, then today's forward contract price is going to be around 60, because that is the expectation of forward price of the underlying asset. And that is very important. You have to remember that the forward price, the contract which is signed between two parties, is derived from the values of the spot market underlying, but the spot market price in future is not known in the month of Jan, and therefore this is an expectation of the 60 is an expectation of spot price of underlying in March. You might see that in future it might be 60, it might be 62, it might be 58. Future is not seen, it is just estimated. But the total number of traders expect that today the price of the underlying will be 60 in future, and that's how the contracts are designed. Now what happens is the contract price is agreed upon today and the contract is signed today. As the time passes, you can see that the price of this commodity also keeps on changing. Similarly, the forward contract itself can be traded or it can remain there with the people, because if it is a forward contract, it's only between two people, so it will remain same. And then you can see that it remains same here as well, because it's a contract fixed price. So what happens is basically, if you are now taking a long forward, and as we have seen in the previous slides, long forward is that when you expect the price of the underlying to go up in future, right? Then you would like to take a position in this market. So you have signed a contract at 60. You will be buying the underlying. If you are a firm, you agreed to buy the underlying at 60 and buy the underlying, or you can see that when you buy the underlying at 60, and if the price in the spot market also is 60, you have made no loss, no profit. But if in the spot market the price is 62, you have made a profit of 2 rupees, because you are buying at 60, whereas spot market price at that time is 62. On the other side, if the spot market price is 58 and you see that you are buying it at 60, then you have made a loss of 2 rupees. And that's how the contract prices. So you can see that there are two different markets, spot market and forward market. Forward market contract is derived from the spot market underlying. Underlying varies according to its demand and supply. Forward being constant, it's a contract, the face value doesn't change. However, one can see that whether there is a notional loss or gain in the futures market by the party who has signed this. There is a history of how the forward and futures market is developed over the period across the world and in India. You can go through this in detail. I will be sharing this PPT with you, and you can see that how in India we started the futures and forwards, and what is the status, who are the regulators. Basically, Forward Markets Commission and SEBI regulate this. Okay, now you can see that the contract terms and conditions of these forwards are supposed to at least cover size, quotation unit, minimum price fluctuation which is allowed, and grade and trading hours. It also specifies delivery terms, daily price limits, delivery procedure. The contract size means that how many number of units a particular contract will cover. When you sign a contract, that means that if I am saying that the price of the share is 50, how many shares will be purchased by signing this contract. The quotation unit in which price it is quoted is it is dollar, rupees, baht, like this. The minimum price fluctuation is the smallest unit of quotation. Right? What is the minimum possible price which you see, and what is the? You can see that there are different types of forwards and futures, but standardized products, interest rate futures, foreign currencies futures, stock index futures, bond index futures, and cost of living futures. You can see that many of those futures are there and their underlines are mentioned here. So interest rate, the treasury bill, notes, bonds. So you can see that the basic feature of this is interest, and interest rate future are based on what happens to interest rate changes of these products. Similarly, if currency rates are there, what happens to currency rates in future? Indices of the stock, what happens to indices in the future? Indices of bond prices, what happens to bond prices in future? And similarly, you can see that there are some products which are based on the inflation. Okay, I'll be sharing this as well. One can go through the contracts. One can see that contract size, symbol, minimum tick size, movement, trading hour, contract months, price limit, last trading day, settlement, how the settlement happens. There are some specifications. You can see another example. You can also go on this website to see how. Now we are going to come to this point. Why trade futures or forwards? Why trade this? As we have seen in the beginning itself the logic behind it, but then let's look at it from two perspectives. One from the perspective of the hedgers and the other from the perspective of the speculators. Now first look at the hedgers perspective. The hedgers are nothing but the firms who have the basic exposure to the underlying. That means the company which is required to buy certain goods in future are exposed to the price fluctuation of that underlying. On the other hand, the speculators, they are not exposed to the underlying. What happens to the price of the underlying in future determines their profit, but not the exposure. They are not required to buy or sell. They will be only buying or selling the contract. So from the hedgers perspective, who are exposed to the underlying, by signing the forwards or futures contract, the party is ensuring that the price of the underlying is fixed today itself. That means whatever happens to the spot market, the company has ensured by signing this contract today that they will be buying at 60 in the month of March. That means you are actually hedging the variation. So there is no variation you can see in the contract price, but then in the underlying the prices are keep fluctuating. Now you can see that in this particular example, when the price is fixed at 60, what may happen in the spot price? The company will buy the underlying at 60. or settle at 60. That means the difference between the spot and forward will be settled. That means whatever is happening in the spot market, it is irrelevant for the futures market, barring the calculation of notional profit or loss. Now look at the other side, that the speculator. Now speculator takes a position on the same contract when already the hedger has signed a contract. So when hedger signs a contract, he is required to buy the underlying at the end of the period. When the speculator takes a position, he takes a position after the position taken by the hedger, and then he can close the position, he can settle, or it is called offset his position before the actual delivery date or settlement date. So you can see that the speculator can offset the position before the delivery date or the settlement date. Now what that actually implies is that the speculator is actually buying and selling in between, but he is not going to keep the position open till the end. If he is buying here, he'll be selling it here. If he is selling it here over here, he'll be buying it here. But before the delivery date of the contract. If the delivery date, before the delivery date, the contract is not offset, then the speculator has to buy the underlying, which is not required by the speculators to be purchased because he is not a hedger, he is not a firm. The speculators actually provide the liquidity to the market. Say, for example, when the firm signs a contract, long forward contract or futures contract, there will be some person who will be having short position, because if somebody is buying, there will be somebody is selling. Now, if it is a forward, the other party is selling. If it is a future, the exchange becomes the intermediator, and the other side, the speculator's side. So we have seen the difference between the speculators and why the speculators are in picture, because they want to return, want to get a return for their position which they take. So basically, the hedgers want to take the position to manage their price risk, whereas the speculators try to see that whether there is an opportunity to earn profit. Now, as we seen that the businesses, the firms employ a long hedge to lock in the price of the raw material they wish to purchase sometime in future, that we have seen. And the opposite is the position when the selling price of the product to be sold in future, a short hedge is used. For example, farmer has sown some crop and he believes that the price of that particular crop is going to go down in future. Say, for example, similar example, but instead of 50, it is going to be 40 in future. Then the farmer will sign a contract today itself at a given price, so as to fix that price, whatever happens to the future. So, for example, we'll talk about here only the things will change, and instead of long, a person can take a short now. And what is expected is, so it may be 46, it may be 44, or maybe 48. You can see that the prices are expected to go down, right? And suppose the forward contract based on these expectations is 46, then the farmer who is growing the crop signs a contract today to sell the commodity in future at 46. So whatever happens in the spot market, whether it goes to 44 or 48, he has fixed the price at 46. So you can see that a short hedge is generated like this. So when long edge is signed, when you see that the prices of the underlying is going to go up and you are required to buy it, and when you see that short edge is taken, the case where the firm is required to sell its products or underlying in future, and they expect that the price of that underlying or the commodity is going to go down in future. Speculators, just for the purpose of the liquidity and making the profit, as we have seen in earlier discussion. Okay, as I said, the offsetting a trade. So when you buy a futures contract to begin with, and you can actually sell the future contract in the future. Buy versus sell. If you are taking a sell position in the beginning, then we'll take the buy position in the future. So that is what I was saying here, that you will have to offset the position before the actually contract settles. I mean contract matures. The clearing house, as we can see that now there is a person in between. So first, if we see that there is a buyer and there is a seller, and he promised to pay 20,000 to purchase 5,000 bushels of the wheat. Bushels is like kgs, and the seller at the same time promises to deliver 5,000 bushels. This is a simple contract to be signed for the future promises. So it's a promise, you can see that. So now if clearinghouse comes in between, the same thing which is promised earlier by the buyer remains there, but he promises to the clearinghouse, and clearinghouse in turn promises it to the seller. Similarly, seller promises to the clearinghouse, and clearinghouse will promise it to buyer. So we got a third party, and in this case you may find that the buyer may not know the seller. Now the settlement, the position of this contract can be done with actual physical delivery. So as we can see that the farmer who is required to buy the underlying, you will actually buy the underlying, or instead of the underlying, you can actually do the settlement, cash settlement. That means the difference between the price will be paid to the party. Offsetting, you take the buying position in the beginning and ending, and then that can be settled. Exchange of futures for physicals, when before the actual delivery time happens, or when the expiry date comes very near, the parties who are involved, basically forward contract, the people, they come to know and they settle the contract outside the exchange, then it is called exchange of futures for physicals. Now we are going to look at what are these long positions and how it actually looks. So the same part which is there in the graphs, we can actually put it on the payoff table, as it is called. So as we see that this is a particular chart which has both positive and negative sides, and there is a one horizontal x-axis which is talking about futures price, the price which is expected to move along this line. And in the long future, suppose as shown there, we can also take this as 40. The future price is 40, and today the sign at 40, and if the future the price goes to 50, or it might come down to 30. Now let's take a look at what happens to the person who has taken a long position in the forward or futures market. What was signed by the firm was that they will buy the underlying at 40. So the long position is basically saying buying the underlying here. If they want to buy the underlying in future, they are not bothered about what is happening to the price of the underlying over the period. So if the price of the underlying goes to 50, still the person who has signed the contract will be buying the product at 40. That means the market price is 50, whereas he is buying at 40. That means a profit of 10. So you can see that 10 profit is made by this person here. If it goes to 30, the market price of the futures contract goes down to 30, whereas he has to buy at 40. So that means there is a loss of 10. So you can show this as positive and this as negative, and you can show it as negative here. So loss of 10, negative 10, and this is positive 10. And that point can come here. And similarly, for other points, you can draw it. And when you join these points, you can see that it's a straight line, which is looking like this. So the long position who expect the price of the underlying to go up in future, and the futures contract price accordingly also fluctuates over the period, and when the underlying price goes up in future, the person gets a profit. This is the profit region. So you can see that this is the profit region and this is the loss region. So if the price of the underlying goes up in future, really, the person who has signed the contract makes a profit. If the person who has signed this contract and the price of the underlying goes down in future, makes a loss. I hope this is clear. We can talk about the other positions, that is short, and also we can see that the options in the next module, how the options actually are different from them, and also we'll try to solve some problems. But I'm just stopping here because first try to understand what these long futures or long forwards are, trying to understand how the profit and loss is there. I'll do that short short forward example next class, so that there is no confusion between the long and short forward. So thank you for listening to this today's session. Thank you.